There is a very good chance that being 65 or older changes the way you should look at your Canadian tax return. And no, I am not talking about some secret loophole or a special trick that lets you avoid paying taxes. I am talking about legitimate tax credits, deductions, and income splitting opportunities that the Canada Revenue Agency already recognizes, but that many seniors simply overlook. And here is why this matters. When you are retired, even a relatively small tax saving can matter more than it did when you were working. Your income may be coming from CPP, OAS, a workplace pension, a RIF, investment income, or several sources at the same time. You may also have prescription costs, dental expenses, mobility-related expenses, home modifications, or caregiving costs that were not part of your financial life years ago. The problem is that many people assume their tax return is simple because they are retired. That assumption can be expensive. Today, we are going through several important federal tax measures Canadian seniors should know about, including the age amount, medical expenses, pension income splitting, the pension income amount, home accessibility expenses, caregiver-related credits, disability-related measures, charitable donations, and one particularly important renovation credit for families living together. And stay with me because later in this video I will explain one of the biggest mistakes seniors make when they hear the words tax deduction, and why claiming something does not necessarily mean you will receive that exact amount back from the CRA. If you enjoy straightforward information about Canadian seniors, retirement income, CPP, OAS, GIS, taxes, and government programs, subscribe to the channel and turn on notifications so you do not miss important updates. Now, let's start with the tax break that is directly connected to turning 65. If you were 65 or older on December 31st of the tax year, you may be able to claim the federal age amount. This is important because the age amount is specifically designed for older Canadians and can reduce the amount of federal income tax you owe. For the 2025 tax year, the CRA says you generally qualify if you were 65 or older on December 31st, 2025, and your net income was less than $105,709. For someone whose 2025 net income was $45,522 or less, the maximum federal age amount was $9,028. But there is an important detail that $9,028 is not a $9,028 cash refund. This is where tax terminology causes confusion. The age amount is a non-refundable tax credit. In other words, the amount is used in calculating your tax reduction. It does not mean that the CRA automatically sends you a check for the full amount, and as your net income rises above the lower threshold, the amount you can claim is reduced. So imagine two Canadian seniors who are both 67 years old. They are the same age, but their financial situations are different. One has relatively modest income from CPP, OAS, and a small pension. The other has a larger workplace pension, RRIF withdrawals, and investment income. The first person may qualify for the full age amount, while the second may qualify for a reduced amount or potentially none of it, depending on their net income. That is why age alone is not enough. You need to look at your income, and there is another detail that many couples overlook. If you have a spouse or common law partner, there can be situations where certain unused amounts can be transferred between spouses or partners, depending on the credit and the circumstances. The CRA specifically notes that certain amounts from a spouse or common law partner may be transferred when the spouse does not need the entire amount to reduce their federal tax to zero. So if you are married or living common law, do not automatically treat your tax returns as two completely separate calculations. Sometimes, looking at both returns together can reveal an opportunity, but the age amount is only the beginning. Because for many seniors, the biggest tax-saving opportunity may not come from age at all. It may come from expenses you paid during the year. And that brings us to medical expenses. Think about how much healthcare spending can accumulate over a year. Prescription drugs, dental work, certain medical devices, professional services, travel related to medical treatment in qualifying circumstances, attendant care, and many other expenses that can potentially qualify under the CRA's medical expense rules. Now here's the mistake. Some people look at one large medical receipt and decide it is too small to matter. Others assume that because they paid for something themselves, it automatically qualifies. Neither assumption is safe. The CRA has detailed rules about what counts as an eligible medical expense, and the calculation depends on your income as well. For the 2025 tax year, for example, when calculating the federal medical expense tax credit for yourself, your spouse or common law partner, and certain dependent children under 18, the CRA instructs taxpayers to subtract lesser of 3% of net income, or $2,834, from eligible medical expenses before determining the allowable amount. That means a senior with significant eligible medical expenses should not simply throw away receipts because they assume they spent not enough. Add the expenses together. Then check the CRA rules. And there is another strategy worth knowing. If you have a spouse or common law partner, the CRA specifically suggests comparing which spouse would receive the better result from claiming eligible medical expenses. This can matter because the threshold is connected to net income. If one spouse has substantially lower net income, the same household medical expenses could potentially produce a better result when claimed by that person, assuming all the eligibility requirements are met. That is why married seniors should not simply divide receipts in half. The tax return should be looked at as a household strategy where the rules allow it. And please remember something very important. Do not claim an expense simply because someone online says seniors can claim it. The CRA maintains detailed eligibility rules. Keep your receipts, keep supporting documents, and if you are unsure whether a particular medical expense qualifies, verify it through the CRA or with a qualified tax professional, because an incorrect claim can create problems later. Now, there is another tax strategy that can be much more significant for some retired couples, and it has nothing to do with medical receipts. It has to do with how pension income is allocated between spouses. If you are married or live in common law and one spouse has significantly more eligible pension income than the other, pension income splitting deserves serious attention. Under the federal rules, eligible couples may jointly elect to allocate up to 50% of eligible pension income to the other spouse or common law partner. The purpose is relatively straightforward. Instead of having all eligible pension income taxed in the hands of the spouse who received it, the couple may be able to shift part of that income to the lower income spouse for tax purposes. But this is not something you should do automatically. You need to determine whether the income actually qualifies. The CRA says the transferring and receiving spouses or common law partners generally must have been residents of Canada on December 31 of the tax year or meet the relevant rule for a deceased individual. They must make a joint election using Form T 1032, and the election can allocate up to 50% of eligible pension income. This is particularly interesting for couples where one spouse receives a workplace pension or other eligible retirement income while the other spouse has much lower taxable income. Let's use a simplified example. Suppose one spouse has $60,000 of eligible pension income and the other has very little taxable pension income. Under the rules, the couple may potentially elect to split part of the eligible pension income rather than having the entire amount taxed on the first spouse's return. But notice the wording. I said may potentially. I did not say that every $60,000 pension can be split. Eligibility depends on the type of pension income and the taxpayer's circumstances. CPP and OAS, for example, should not simply be assumed to qualify for pension income splitting under these rules. The CRA distinguishes OAS and CPP from other pension income, and its pension income splitting rules identify specific types of eligible income. That distinction is extremely important. One of the most common mistakes in senior tax discussions is treating every form of retirement income as if it were interchangeable. It is not. OAS is not the same thing as a workplace pension. CPP is not automatically the same thing as RRIF income. RRSP withdrawals are not automatically the same thing as eligible pension income. The source of the money matters. And if you are considering pension income splitting, look at the entire household picture. Could splitting lower the higher income spouse's tax? Could it affect other income tested benefits? Could it affect the lower income spouse's tax position? Could it change eligibility or the amount of another benefit? Those questions matter. And that leads directly into another credit that many seniors miss. If you reported eligible pension, superannuation, or annuity payments, you may qualify for the federal pension income amount. The CRA lists this as line 31400. Again, the exact eligibility depends on the type of income you received. This is one reason your T4A, T4RIF, and other tax slips should not simply be filed away without checking what they represent. For example, the CRA's Retirement Income Summary explains that certain amounts reported on line 11500 can make a taxpayer eligible for the pension income amount and pension income splitting. For a retiree, the tax return is often a collection of different income streams. That means the tax treatment can differ from one slip to another. This is also why seniors should be cautious with generic online advice, such as all pension income gets the pension credit. That is too broad. The correct question is, what kind of pension income did you receive? And what does the CRA say about that specific type? This may sound like a small distinction, but it can be the difference between a correct tax return and an incorrect one. Now, we have covered age, medical expenses, pension income, and income splitting, but there is another area that deserves attention if you own a home, especially if you have started making your home safer or easier to access. Imagine you are 72, you own your home, you are still independent, but stairs are becoming difficult. So you install permanent handrails, or you make an accessibility-related renovation that helps you move safely through your home. You may want to investigate the federal home accessibility tax credit. The CRA says a qualifying individual who is 65 or older at the end of the year may be eligible for the credit when eligible renovations improve accessibility or reduce the risk of injury in an eligible dwelling. For the 2025 tax year, a qualifying individual can claim up to $20,000 in eligible expenses per year, subject to the rules. This is a significant number. But again, it does not mean a senior receives $20,000 from the government. The $20,000 is the maximum amount of eligible expenses that can be used for the credit. And there are specific requirements. The renovation has to qualify. The dwelling has to qualify. The expense has to be eligible. And the renovation must generally be of an enduring nature and integral to the home. Routine repairs and maintenance do not simply become eligible because the homeowner is over 65. This distinction is extremely important. A senior cannot simply renovate a kitchen, paint a bedroom, or replace ordinary household equipment and call it an accessibility expense. The purpose and nature of the renovation matter. There is also a particularly important change for 2026 and later years. Budget 2025 proposed changes so that, beginning with the 2026 and subsequent taxation years, an expense claimed under the medical expense tax credit cannot also be claimed under the home accessibility tax credit. In other words, the ability to claim the same expense under both credits is being restricted for 2026 and later years. So if you are planning accessibility renovations in 2026, this is exactly the kind of rule you should verify using the latest CRA guidance before filing, and keep every invoice. Do not rely on memory. Do not rely on a contractor's verbal statement that something is tax deductible. Get the documentation. Because later, if the CRA asks you to support your claim, you want the paperwork. Now let's move to a situation that affects many older Canadians but is often overlooked. What happens if you are financially supporting another adult who has a physical or mental infirmity? Retirement does not always mean your financial responsibilities disappear. Sometimes the opposite happens. You may be supporting a spouse, an elderly parent, a grandparent, a sibling, or another qualifying relative who relies on you because of a physical or mental infirmity. The Federal Canada Caregiver credit may be available in qualifying circumstances. The CRA says this is a non-refundable tax credit for people who support a spouse, common law partner, or certain dependents with a mental or physical infirmity. The rules depend on who you are supporting, their income, your relationship to them, and the circumstances. For example, the CRA's 2025 information shows that certain adult infirm dependents can result in a Canada Caregiver amount of up to $8,601, depending on the circumstances. Again, that figure is not a check, it is a credit amount used within the tax calculation. And eligibility can change depending on the dependent's income and whether other credits are being claimed. This is why one of the most dangerous approaches to taxes is to hear a number online and assume that number is what you will receive. Tax rules do not work that way. The number attached to a credit is not necessarily the amount of tax you save. The actual result depends on your tax situation. If you support someone with an impairment, however, do not automatically assume there is nothing available to you. Check the Canada Caregiver credit rules. And if you are supporting someone with a disability, there may be additional disability-related measures worth investigating. This section is particularly important because disability-related tax rules can interact with several different areas of the tax return. The CRA lists disability-related measures including the Disability Supports Deduction, the Canada Caregiver Credit, the Home Accessibility Tax Credit, the Disability Tax Credit, and certain amounts that can be transferred from a dependent or spouse. The Disability Tax Credit itself is not simply an age 65 benefit. You do not qualify merely because you are a senior. Eligibility is based on the specific disability criteria and the CRA approval process. But if you have a qualifying impairment, or if you are supporting someone who does, it is worth understanding the rules. And this is one area where professional advice can be especially useful. Why? Because disability-related tax rules can become complicated very quickly. You may have medical expenses, you may have accessibility renovations, you may have attendant care, you may have support expenses, and different rules can apply depending on what was paid, who paid it, who received the service, and whether a particular certificate or approval is required. Do not wait until tax season to start searching through old receipts. If you expect significant medical or disability-related expenses, create a simple folder during the year. Keep receipts. Keep invoices. Keep documentation from medical professionals where required, and make notes about what each expense was for. That small habit can save a tremendous amount of time later. Now here is another opportunity that can matter to seniors who live with family, and unlike the home accessibility credit, this one is connected to creating a separate living space. Suppose you are a senior and your adult child wants to create a self-contained secondary unit so that you can live with them while maintaining more independence. Under the federal Multigenerational Home Renovation Tax Credit, eligible taxpayers may be able to claim a refundable tax credit for qualifying renovations that create a secondary unit for a senior or an adult who is eligible for the disability tax credit to live with a qualifying relative. For the 2025 tax year, the CRA says the credit can be based on up to $50,000 of qualifying expenditures with a maximum credit of $7,250 per eligible claim, subject to the requirements. Notice something important here. This is a refundable tax credit that is different from a non-refundable credit. A refundable credit can potentially produce a payment even when your federal tax payable has already been reduced to zero, subject to the specific rules. That makes understanding the distinction between refundable and non-refundable credits especially important. But once again, you cannot simply spend $50,000 on any renovation and expect the credit. The renovation must meet the program's definition. The secondary unit must qualify. The relationship between the people involved must meet the rules, and the renovation has to meet the relevant conditions. So if your family is considering this type of project, investigate the CRA requirements before construction begins, rather than assuming the expenses will qualify afterward. That is a recurring theme in senior tax planning. Planning before spending can be much easier than trying to fix a claim after the money is gone. And there is another tax credit that may be especially relevant if you regularly support charitable organizations. Many Canadian seniors continue to donate to charities throughout retirement. If you do not throw away your donation receipts. Eligible donations to registered charities and other qualified donees can generate a federal charitable donation tax credit. The CRA says either you or your spouse or common law partner may be able to claim the eligible amount of a qualifying gift. There is also an important household strategy. Depending on the circumstances, spouses may choose who claims eligible donations. The CRA allows the eligible amount of donations to be claimed by either spouse or common law partner in the household, subject to the rules. And unused donation amounts can generally be carried forward for future years, subject to the applicable limits. This means that if you made charitable donations but did not claim the full amount in the year, do not assume the opportunity disappears immediately. But again, documentation matters. Make sure the organization is a qualified donee and keep the official donation receipt. A bank statement showing money left your account is not necessarily the same thing as a valid charitable donation receipt. And if you donated property rather than cash, the tax rules can become more complicated. So this is another area where checking the CRA guidance is worthwhile. Now we have reached a point that I really want every senior watching this video to remember. Most of these opportunities are not automatic senior payments. They are part of the tax system. And that means you have to understand how they interact with your income. This may be the most important concept in the entire video. The phrase tax deduction is commonly used online as a catch-all term for anything that reduces your tax bill. Technically, however, deductions and credits are not the same. A deduction generally reduces the income that is used to calculate your taxable income. A non-refundable tax credit generally reduces the tax calculated on your income, but cannot normally create a refund beyond the amount of tax otherwise payable. A refundable tax credit can potentially result in a payment even when tax payable has already been reduced to zero, subject to its rules. That distinction explains why you should never hear someone say, you can claim $9,028, so you will get $9,028 back. That statement would be misleading. The 2025 federal age amount, for example, had a maximum claim amount of $9,028 for qualifying seniors with net income of $45,522 or less. But the age amount is a tax credit, not a $9,028 cash payment. The same principle applies to the $20,000 home accessibility tax credit expense limit, and it applies to the $50,000 maximum qualifying expenditure amount under the Multigenerational Home Renovation Tax Credit. The expense amount and the actual tax benefit are not necessarily the same thing. This is why reputable tax information should explain the mechanism, not simply throw large numbers at you. And if you were watching videos about Canadian taxes, always ask, is this a deduction? Is this a non-refundable credit? Is this a refundable credit? Is the amount a maximum expense? Or is it the actual tax reduction? Those 5 questions can save you from a lot of confusion. Now let's talk about another issue that seniors sometimes overlook. The tax return does not exist in isolation. Your tax return can also interact with income-tested government benefits. For many Canadian seniors, taxes are not only about the amount of income tax they pay. Your reported income can also matter for certain government benefits and income-tested programs. This is especially important for people receiving or applying for benefits such as the Guaranteed Income Supplement. That is why a tax strategy should not be based solely on the question, how do I reduce my tax bill? A better question is, how do I legally manage my tax situation without accidentally creating an unwanted effect elsewhere? For example, pension income splitting may reduce one spouse's taxable income and increase the other spouse's reported income. That could change more than just the tax calculation. The same principle applies to withdrawals from registered accounts. A large RRSP or RRIF withdrawal may create taxable income in a particular year. That could affect your overall tax picture and potentially income-tested programs. This does not mean you should avoid withdrawals that you need. It means retirement tax planning should consider the bigger picture. If you are receiving GIS or another income-tested benefit, be particularly careful before making major decisions about taxable income. Do not assume that the strategy producing the lowest income tax today is automatically the best strategy for your entire household. Sometimes the best strategy is about managing several years together rather than optimizing one tax return. And this is where professional tax advice can be worth paying for, especially if your income comes from multiple sources. Now let's talk about timing. The first major rule is simple. Tax credits and deductions are tied to specific tax years. The 2025 tax return is based on income and circumstances from 2025. The 2026 tax year will have its own rules. That sounds obvious, but it becomes very important when governments announce changes. For example, the CRA's Budget 2025 information explains that proposed changes affect how the Home Accessibility Tax Credit and Medical Expense Tax Credit interact for 2026 and later taxation years. So do not automatically take a rule that applied in 2025 and assume it applies identically in 2026. Tax rules can change, thresholds can be indexed, credits can be modified, provincial and territorial credits can differ, and new legislation can change how a measure works. The second important rule is documentation. When you file your return, you generally do not send every receipt to the CRA automatically, but you should keep supporting documents because the CRA can ask for them later. That means your tax file should be organized. Medical receipts, donation receipts, renovation invoices, pension slips, RRIF slips, statements related to eligible expenses, and documentation for caregiver or disability-related claims where required. A simple system can make the next tax season much easier. Let's go through some of the most common mistakes. The first is assuming that turning 65 automatically means you receive every senior tax credit. It does not. Some credits have income thresholds. Some depend on your relationship to another person. Some depend on specific expenses. Some depend on disability criteria. And some depend on the source of your income. The second mistake is confusing a credit amount with cash received. A $9,028 age amount does not mean $9,028 lands in your bank account. A $20,000 home accessibility expense limit does not mean the government pays $20,000. Understand what the number represents. The third mistake is ignoring the spouse's tax return. If you are married or living common law, review the household tax situation together. Medical expenses may be better claimed by one spouse. Donations may be better claimed by one spouse. Pension income splitting may be worth considering, and certain unused amounts may potentially be transferred. The fourth mistake is assuming CPP and OAS can be treated like every other pension. They cannot. The CRA separately identifies CPP and OAS income, while pension income splitting rules apply to qualifying types of pension income. The fifth mistake is relying on social media posts instead of official information. If a Facebook post says, "Every Canadian over 65 gets $10,000 back," be skeptical. If a video says, "CRA is giving seniors a new tax check," check the source. If someone tells you that a particular renovation is guaranteed to qualify, verify it. Your tax return is not the place to experiment with rumors. And the sixth mistake is waiting until the last minute. If you know you have medical expenses or a major home renovation, organize your records immediately. Do not wait until you are staring at your tax software 6 months later wondering where the invoice went. So what should you actually do? Start with your age and income. If you were 65 or older at the end of the relevant tax year, check whether you qualify for the age amount and determine whether your income reduces the claim. Next, gather your medical expenses. Do not just look at prescriptions. Review dental, vision, medical devices, professional services, and other expenses against the CRA's eligibility rules. Then look at your pension income. Identify your CPP, your OAS, your workplace pension, your RRIF, your annuities, and other retirement income. Do not assume they all receive identical tax treatment. If you have a spouse or common law partner, review the possibility of pension income splitting if you have eligible pension income. Then look at your home. If you made accessibility renovations, check the home accessibility tax credit requirements. If your family created a qualifying secondary unit for a senior, investigate the multi-generational home renovation tax credit. If you support a family member with a physical or mental infirmity, check whether the Canada Caregiver credit or disability-related measures could apply. And if you donate to charity, make sure you have official receipts and consider whether you and your spouse are using the donation credit in the most appropriate way under the rules. Finally, review the latest CRA information before filing. The rules can change from one tax year to the next. Here is a simple way to think about your tax return. First ask, what income did I receive? Then ask, what expenses did I pay? Then ask, which of those expenses are actually eligible? Then ask, are there credits or deductions related to my age, health, home, spouse, dependents, or retirement income? And finally ask, could claiming something affect another benefit or income-tested program? That final question is particularly important for lower-income seniors. The tax return is not just a form you complete once a year. It is a snapshot of your financial circumstances that can interact with other government programs. If you receive GIS, for example, do not make major taxable income decisions without understanding the broader consequences. If you are taking large RRSRF withdrawals, consider how they fit into your multi-year retirement plan. If you are doing a major renovation, determine eligibility before spending the money. And if you are supporting an infirm family member, investigate the caregiver and disability rules rather than assuming the expenses are simply personal costs. The goal is not to beat the CRA. The goal is to make sure you are using the tax rules you are legitimately entitled to use. If you remember only one thing from this video, remember this. Being 65 or older does not automatically give you one giant senior tax deduction. Instead, retirement can open the door to a combination of tax measures that may apply depending on your age, income, pension income, medical expenses, home renovations, family responsibilities, disability circumstances, and charitable giving. The age amount can be important, medical expenses can matter, pension income splitting can be valuable for some couples. The pension income amount may apply to eligible pension income. Accessibility renovations may qualify. Caregiver credits may apply when you support an infirm family member. Disability-related measures can become important for qualifying individuals. Charitable donations can produce tax credits. And qualifying multi-generational renovations may qualify for a refundable tax credit. But none of these should be treated as automatic money. Eligibility matters, income matters, documentation matters, and the tax year matters. The 2025 figures we discussed are based on CRA information for the 2025 tax year, which is filed in 2026. Federal and provincial or territorial rules can differ, and future tax years can change. That is why the safest approach is to use the CRA's current guidance for the exact tax year you are filing. And if your tax situation is complicated, especially if you have pensions, investments, a DAR-RIF, rental income, a spouse with different income, significant medical costs, or a major renovation, consider getting advice from a qualified Canadian tax professional. Conclusion: if you are 65 or older, do not look at your tax return as nothing more than a record of how much money you earned. Look at it as a record of your entire financial year. Your income, your health expenses, your home, your spouse, your dependents, your charitable giving, and your retirement income. Those details can determine whether certain tax measures are available to you. And one final reminder, always distinguish between a deduction, a non-refundable tax credit, and a refundable tax credit. That single distinction can prevent some of the biggest misunderstandings about senior tax savings. You do not need to find a loophole. You do not need to do anything aggressive. You simply need to make sure you are not overlooking legitimate measures that already exist in the Canadian tax system. So before you file your next return, take a second look. Check your age amount eligibility, review your medical receipts, look at your pension income, consider pension splitting if you have eligible pension income, check accessibility or multi-generational renovation rules if they apply, review caregiver and disability-related measures, and make sure your donation receipts are organized. A few minutes of careful review could help you avoid leaving a legitimate tax opportunity on the table. If this video helped you understand Canadian senior tax rules more clearly, subscribe to the channel and turn on notifications. We cover Canadian retirement taxes, CPP, OAS, GIS, Service Canada, government benefits, and important financial information for seniors in straightforward language. And remember, tax rules change, so always check the latest CRA information for the tax year you are filing. Stay informed, keep your records organized, and make sure you understand the benefits and tax measures you may legitimately qualify for. Your retirement income matters, and understanding the rules can be just as important as earning the money in the first place.